Hopefully you're doing well. Want to talk to you today about student loans and how you can get into a home if you currently have student loans. Let's get into it. The first place I want to go and have us look is with the FHA Loan Guidelines. The student loans that show up on your credit report, on your liabilities, regardless of the payment type or status of payments. So, regardless of what shows up on the credit report, forbearance, deferment, regardless, we as lenders have to calculate a payment. And I want you to know that's not new. We've always calculated a payment for you if you've had student loans. The good news is now with FHA, some changes have been made to help mitigate inflation, the higher cost of things. So for outstanding student loans, regardless of payment status, the mortgagee must, on FHA loans, we must use the payment amount reported on the credit report or the actual documented payment when the payment amount is above zero. More times than not, when I pull a credit report and look at your credit report, I'm going to see one or two things. First of all, depending on when you took out a certain dollar amount for a student loan, there may be several different trade lines that make up your total pie, your total balance of your student loan debt. So when those different allotments were taken out, you're going to have the term, how long that student loan is supposed to be amortized for, and then a payment. In a lot of cases, there's not a payment. So if you had like a $5 payment on the credit report, okay, then there's a possibility that we could use that $5 payment if I could get the documentation from your student loan servicer showing that's the case. And just to give the spoiler away, the only way that will happen is that you all need to take advantage of all of the income-based repayment options that are available. The old ones and the revamped. If they're available, you need to take advantage of it because that is another way that you can use a lower amount than what you would otherwise have to pay, either by step 2 in the calculation, if your student loan is showing zero and you have an FHA loan that you're trying to do, then we as lenders have to take a half of 1%, a half of 1% of the outstanding debt to help you qualify. That used to be 1%. So here's the deal. Income-based repayment. Just give you the goods up front. No BS. You got to get with your servicer and make sure you're on an income-based repayment plan. And if not, as it pertains to FHA, if there's a goose egg, if there's a zero on your credit report, when we pull your credit report to determine your debt to income ratio, then we have to take a half of 1% of the outstanding student loans, which is a win for you because that 1% used to be a lot larger, a half a percent more, and could negatively or adversely affect you from getting into your home. The second option is VA. Here's the deal. Say you're closing on a loan today, 10/4/2023. If we can provide documentation that shows that your student loans will be deferred until 10/5/2024, I like to go a year and a day. So a year and a day from today is when your student loans will start. Then I don't have to calculate those payments in your debt to income ratio. Now, again, common sense will let us know that, hey, you don't need to be qualifying for anything that you can't make the payment on. But in light of inflation and things going up, we're doing all that we can do to help mitigate the cost of getting into a home. Okay. So again, with VA, 12 months. If your payment for your student loans are going to start 12 months from the day that you close, they'll be deferred, then we don't have to use that. Now, if not, we go to the green section here, B, and it says if a student loan repayment is scheduled to begin within those 12 months, okay, you close in 10/4/2023 and your student loan payment starts September 1, 2024, then we have to default to the following calculation, right? Of the date of the VA loan closing, we as lenders must anticipate the monthly obligation in your debt to income ratio. And the way we do that is below. We calculate your total amount due for your student loans, all those different allotments, take the total pie. Okay, we multiply it by 5% and then divide that number by 12. Okay, and in the example below, 25,000, 5% equals 1250 divided by 12. So the payment that we would allocate for all of that student loan debt is $104.17. And it's a tad bit lower than 0.5%. Okay, because like I said, VA's just got to be great, right? Got to win all the way around. So going over to USDA. Again, guys, let me stress, for outstanding student loans, regardless of the payment status, we as lenders must calculate a payment, okay? So for USDA, the payment amount reported on the credit report or the actual documented payment when the payment amount is above zero, okay? Or if it's zero, okay, if it's zero, then we could take 0.5%, 0.5% of the outstanding student loans, outstanding loan balances documented on the credit report or a credit or a creditor verification when the payment amount is zero. All right. Same trend, right? It's either 0.5% so far with the FHA and really VA, little less than 0.5%, and then with USDA. So all of the government insured loans that you might do give you an excellent opportunity to qualify and not have that total amount counted against you. But the key, the secret sauce to all of these programs is you tapping in to the repayment programs. Okay, doing it early, often, and don't let your loans go into forbearance or deferment, because I'll do another video on this, but that's why these loans are growing. It's not something done nefariously. You're not making interest payments. But let's move forward. Let's get into the conventional side. Again, we talked FHA, VA, USDA, government insured, Fannie Mae, Freddie Mac, GSEs, government sponsored entities. That's the conventional side. These loans aren't insured by we the people. Okay. So long and short, when we're looking at Fannie Mae, if you have to go conventional, this is the way you have to, or you should want to go, if we can document that you have a income-based repayment plan and say it's at zero. Because as you can see here on the bulleted point, it says if the borrower is on an income-based driven plan, the lender may obtain student loan document to verify the actual monthly payment is zero. The lender may then qualify the borrower with a zero payment. So on the conventional side, the Fannie Mae loan, and this is something that your lender should know, you don't have to worry about it, but conventionally, Fannie Mae will allow for a zero payment for your total student loan balance. And how does that happen? I see it more times than not, more times than not. The only time I see it is when folks are on an income-based repayment plan, and that's what the documentation from the servicer, the most recent documentation, because typically you're going to look at a 6-month period of your income where they make these calculations, 6, 9 months, 12 at the longest, but it has to be the most recent analysis of your income to show that your payment is zero. And if we have to go conventional, I can use that zero payment, right? And you can too. Now, if not, here's the deal. If your loan is deferred or in forbearance, then we must take 1% of the outstanding balance. That's what FHA used to be, 1%. And for some of you guys, that 1% is huge, okay? So you got to take 1% of the outstanding balance, okay? It says even if the amount is lower than the actual fully amortized payment. So a payment equal to 1% of the outstanding student loan balance, even if the amount is lower than the actually fully amortized payment, or a fully amortizing payment using the documented loan repayment terms. And again, guys, I'm going to do a video on a fully amortized payment because there's a lot of misinformation out here online as to making folks believe I've been making payments for all this time and my payments my balances are growing. They're growing because you're not making the fully amortized payment. But last and most definitely not least is Freddie Mac. So you have Fannie Mae, Freddie Mac on the conventional side. those loans are not insured by the government, right? So what Freddie Mac says is this: you have to take the monthly payment that's reported on the credit report. It says if the monthly payment that's reported on the credit report is greater than zero, okay, the sellers must use the monthly amount reported on the credit report unless other documentation in the mortgage file supports a different current payment amount greater than zero. Okay, that's the key. Whenever they're saying zero, you got to have something from your servicer so we can identify what that payment amount is. Or if the monthly payment on the payment amount reported on the credit report is zero, then the seller, that's us, the lender, must use a half of 1% of the outstanding loan balance reported on the credit report. So don't believe the hype. You can buy. Inflation is up. Affordability is an issue. But as this video showed you today, we as lenders have always calculated your student loan payment in your debt to income ratio with some type of payment. And as a result of what's been going on, changes have been made on the Govy side, on the FHA side, to lower that calculation to help with affordability. No one told you that, but I did. You know why? Home ownership is important and it's awesome when you do it at the right time in your life or your situation and your family, and you understand the full matter. As the title said, no BS. So that's it. Robert Lewis, residential loan originator, 20 plus years. Love to help you. If you like to reach out, look in the comment section or the description below and let's have a conversation. Schedule a consultation, and I would love to help you and yours secure your next home. My time is up. I thank you for yours. As I always say, let's be good to one another. Let grace abound. And until the next time, peace.